Hi, Avinash.
Yeah. Ladies and gentlemen, good day. On behalf of MK Global, I welcome you all to Ugro Capital Q4 FY24 earning call. We have with us today Mr. Sachindranath, Founder and Managing Director, Mr. Anuj Pandey, Chief Risk Officer, Mr. Amit Mande, Chief Revenue Officer, Mr. Kishore Lodha, Chief Financial Officer, and Mr. Sarad Agrawal, Chief Operating Officer. Before we proceed, as a standard disclaimer, no unpublished price-sensitive information will be shared during the conference for discussion during this interaction. In case of any inadvertent disclosure, the same would in any case form part of the call, of the recording of the call. Without much ado, I would like to invite Mr. Sachindranath to share his thoughts on the company's performance and discuss the capital raise and the latest acquisition. Over to you, sir.
Thank you, Avinash. Good evening, everyone. This is actually not just a year-end quarterly result presentation. Obviously, we have done as per our plan for the quarter, but we believe this is a momentous occasion in our life cycle. As you'll all remember, Ugro is a 5-year-old organization. It started as India's first listed startup, 5th of July 2018, when this company was born. This company was born with a combination of 5 private equity investors coming together along with me, and we capitalized this company to the tune of almost 950 or 8 crores. We suffered immediately post our capital raise the crisis of ILFS, the DHFL and Yes Bank. We started our business in April 19 to March 20 was our first year. We deployed our equity capital of 850 crore into the markets and then suffered COVID. COVID period was a time of reckoning, and we used that time to build the scale and size aspiration of ours. Pre-COVID, this company was 120 people company. Post-COVID, it became almost 1500 plus people. We put massive digital and data analytics infrastructure. We put physical infrastructure out with almost 100 plus location, and we brought a large number of lenders on balance sheet, and we created a very massive capacity of co-lending. The resultant of that we in 2022 were 3,000 crore. In 23, we were 6,000 crore, and in 24, we have ended at 9,050 odd crore. Our operating leverage played off. From 7 crore of PAT, we grew to 40 odd crore last year, almost 120 crore this year. But what changes for us that we took a call to raise disproportionate capital to augment our growth. We raised, we have been trying. We have been trying to bring stability to our cap structure, and we have been trying to bring unique capital provider to us. When we started, we brought 4 private equity investors who have defined timeline when it comes to their ownership of us and how long they will remain as our partners. Last year, we brought a global development financial institution in form of IFU, which has a very long-term time horizon. And now, in order to attract domestic capital and family offices, we did this unique structure of CCD and warrants and marketed it to some of the large family offices, and they came into our capital structure. Not only that, if you go to the first slide, please. Not only that, one of our existing investors, which is Samina, actually invested 500 crore through warrants. One large fund invested 210 odd crore, and roughly around 10 large family offices got attracted. This capital raise of 1,332 crores, of which is 275 crore is in form of CCD, 1,057 crore is in form of warrant, actually fulfill our capital need for the year and also fulfill the capital need for next 2 years. And that allows us to continue growing without the worry about of the capital. And that allows us to get to our growth rate very easily. So that is largely on our capital raise. It gives the management the ability to grow without being hindered for capital. It allows the management to focus on getting rating upgrade and reducing its cost of borrowing. And it allows public market shareholder to participate in the growth journey of Ugro. So that largely is on the capital raise. We will answer the question through FAQ. Second, Ashu said that to talk about our acquisition. As some of you know, Ugro's proposition is following. Ugro would like to service the customer segment between 15 lakh to 15 crore turnover. This customer segment constitute roughly 90% of the 90 lakh crore of the credit gap. And this is the customer segment we service through 4 distinct channels. We service the customer through our prime channel, wherein we focus on large ticket secured loans up to 3 crore, business loan for our customers through intermediation, which is likely DSA. We have a large number of micro enterprises branches where we focus on small ticket secured loan. We have ecosystem where we focus on machinery and rooftop solar. We have a supply chain where we focus on retailer. We have a partnership and alliance where we focus multiple types of fintechs and NBFCs who provide service to underlying customer segment at a highly granular and high yield segment. And last is our digital vertical. There is one segment of the market which is wide, large, and whose need we would like to service was not getting serviced by Ugro, which is called embedded financing. Embedded financing means think of a merchant, which is a small retailer near your neighborhood, who uses a Airtel payment bank or a Fino or any of these payment platforms QR code, who buys material for X amount of money, sell the material to end customer, and his payment data is getting captured in some of these payment banks or wallet platforms. Now, if this customer, this merchant needs financing, then how do you provide this financing? How do you provide this financing through an integrated platform? The financing requirement is that he should be able to borrow through this integration, which is called embedded financing, 1 lakh rupees for a 30-day period, and then from his daily sale and EMI he can get it. Our proposition is simple, but the technology solution and the data integration or data analytics around this is quite complex. My Shubh Life in last 7 years have achieved a very high degree of perfection in the embedded financing market through this integration, through this payment platform. His quality of shareholder, the quality of the management and governance have been extremely good. But given where the market is, now market is moving wherein the balance sheet provider as well as the technology lender both have to be integrated. Sorry, excuse me. Sir, whatever is happening, just leave it there. Please don't touch it now. Okay? So both has to be integrated and has to be kept, have to be provided. My Shubh Life, excuse me, this way. Can you just go out? Yeah. Thank you. My Shubh Life as a tech platform has achieved this level of perfection. They came to us for co-lending and we told them that why don't we partner? We spoke to their VC investors. We propositioned to them that they becoming shareholder of Ugro and their long-term benefit is far more profitable because Ugro would continue to grow. For the management team, they get the benefit of our balance sheet, and that's why we structured this acquisition. We are acquiring My Shubh Life at 1.9 times price to book value of their net worth. We are paying a consideration of 45 crore in form of 36% in form of cash, 64% in form of Ugro shares. It would become a subsidiary, and we have aligned and integrated the management team through our ESOP and a profit share model. This acquisition potentially in next 3 years gives us additional 2 lakh retailers as a customer and probably 1,500 crore of AUM at the end of the 3 year, incremental AUM, and roughly around 100 crore of incremental PAT of what we do it organically. We are very excited about this acquisition. This is in line with our DNA of being a data tech company. It's an extension of what we do, and we are being able to inherit a management team whose DNA is entrepreneurial, and they will become part of our family. So I think this acquisition fulfilled the need, one segment of the customer need, which otherwise was eluded from us. Sure.
Yeah, coming back to financials, for the whole year, we have achieved AUM of around 9,047 crore, which is broadly in the line of the guidance which we have given at the beginning of the year. During the year, we have achieved the gross disbursement of 5,867 crore. So now monthly, we are clocking in excess of 500. The year-on-year, that disbursement has grown up by 26%. Last year, we had done a disbursement of 4,600 crore. Of book AUM, we have targeted for about 45%, and our ultimate goal is to reach 50%. We are in line on that. Last year, we are at about 40% of our book AUM. Now we have achieved 45% of book AUM. Pre-tax profit has jumped from 84 crore to 179 crore, which is 113% jump year-on-year. Quarter-on-quarter also, we have the profit has gone up from 34 crore PBT to 56 crore of PBT. PAT has gone up during the year from 40 crore to almost 120 crore. During the quarter-on-quarter, the profit has gone up, PAT has gone up from 14 crore to 33 crore. So there, again, there is a significant jump on profit as well. Net income has moved from 12.2% to 13.5%, which is in the direction where we want to take this forward. As Sachin has explained earlier, into the we are increasing, we are focusing on the yield. Cost to income ratio is gradually getting down, which was 62% last year. Now it has come to 54%. As the economy of the scale catching up, it will go down further. ROA has moved from 1.1% to 2.3%, and ROE has moved from 4.1% last year to 9.9% this year. Our total EPS for the year is about 13.39 rupees per share. Book value is about 157 rupees as on 31st March. This is not considering the current equity raise which we have announced yesterday. The money will flow in, part of it in the coming month, and part of it will come in gradually in the next 18 months' time. Price to earning is about 16.4 on the book value on the market cap of 31st March 2024. This is our aim for, as we have indicated earlier, that about 30%, for which for next year, 2 years, whatever capital we would require, we have already locked in that capital. Of book, as we explained earlier also, that our aim is to reach 50% of the book we will keep on book, and 50% we will take it to off book in the form of co-lending, co-origination, and direct assignment. Cost to income ratio, as of now, is closer to 54%. We would like to take it to 45%, which may take about 6 to 8 quarters from now, and ultimately will reach the desired ROA of 4%, which will, as a management team, we believe that we may take around 8 quarters time.
If I may take that. So one of the questions we have always been asked, what is the bridge from this 2.3 to 4% ROA? Given that this question has been asked to us for many times, we are trying to explain this, how this would happen over 8 to 10 quarters. And there are 4 components to that. The first component is the yield expansion. Our yield expansion is a function of our sheer focus on our second vertical, which is micro enterprises vertical. Micro enterprises vertical, which is, a business wherein 175 locations till third quarter of this year were focused on doing between 8 lakh rupees of average ticket size secured loan. Now that vertical is expanding in 2 ways. We are going to 150 now, and by end of the year, it should be 250 locations. And most of this portfolio of 8 lakh secured loans happens at around 20% yield. Adding to that, Ugro has a very unique proposition vis-a-vis this peer lender set. It is probably the only company which does secured loans of, say, up to 3 crore, business loan through intermediate channel up to 25 lakh. It do micro enterprises secured loan up to 8 to 10 lakh. It does machinery financing, 5 type of machine, CNC, printing, packaging, plastic molding machine, and now rooftop solar. It also does retailer financing and so on and so forth. Now, both our intermediate channel, our micro enterprises, and our machinery channel now would focus on all product together. So not only the expansion in micro enterprises would enhance the yield, but it also would enhance the productivity. because now a small branch of Ugro is being trained, designed, and monitored for being able to do the 10 lakh secured loan, but also at least 1 or 2 large loans, 1 or 2 machinery loans, and 1 or 2 rooftop loans. So that's the first component of ROA bridge. Second component is what we say, cost of borrowing decrease. Cost of borrowing decrease have 2 components. One, the market phenomena, and second, who we are. Given that we have been a young company, we have been growing extremely fast, and our need of liquidity has been large, our cost of borrowing for our size of capital and rating is roughly around 150 basis points higher than our peer set. We are expecting that because of the increase in the vintage, because of the scale getting increased, because of a very sizable capital, almost equal to our existing net worth, there is a 50 basis point rate reduction would happen over 8 quarters, and hopefully some bit of rate cycle change would give us additional 25 to 30 basis points. So we are presuming that in 8 to 10 quarters, cost of borrowing would come down 75 basis points and 50 basis points of operating leverage. Operating leverage has again 2 functions. Our OPEX to our income now is going disproportionately. Our existing physical infrastructure and digital infrastructure is sweating more by multi-product. Our AUM is now growing and our costs are not going in proportion to our AUM growth. And that's the operating leverage of 50 basis point we are presuming. And obviously, as our portfolio seasons, as you have been seeing, we have been guiding towards an overall credit cost of 2%. We have been largely at 1.5%. This quarter, we have increased that little bit, but we think around 50 basis point of credit cost would increase. And that's broadly is the bridge from 2.3 to 4% ROE. In 8 to 10 quarters is what we presume. Avinash, this is it for our side. We have kept the presentation very sharp. Most of the other things in the presentation is already circulated and is available to everyone. But management team would be very happy to answer questions.
Yeah, sure. So we will go to question Q&A.
Stop sharing. Stop sharing. Sound cut off. It's okay.
Yeah, so we have first question from Rahul Bagri.
Please go ahead.
Yeah, thank you for the question. Congratulations on a very good set of numbers in line with what we had guided. Question is obviously related to the huge fundraise that you have done. Now with this quantum of fundraise, how do things change, sir, on 2-3 fronts? One is growth. Are you looking at much faster growth than what you had previously guided for? And are we looking at, the second question was on the ROA front. We used to initially talk about a 4% exit ROA for FY25. Now we seem to be more on the exit run at FY26. Is there a change there, or what are we looking at? These two broad questions first. Thank you.
Yeah. No, thank you so much, Rahul. Very good questions. On the capital front, I think that this capital for the growth which we have been presuming or been guiding was required in any case. The difference is that we have taken all of that capital upfront, but we have designed and taken in a manner that for our existing shareholder, it is not diluting immediately. So the dilution would happen over a period of time, except the increase in the price benefit would not go to existing shareholder. So we have kept something on the table for the incoming shareholder. So we would have needed roughly around same amount of capital to manage our next 2 years of growth. But the capital we have taken in form of a CCD plus warrant. So the money of the CCD and 25% money of the warrant would add roughly around the same amount of equity capital which was required for this years of growth. So our capital adequacy would go up from 21 to around 29% for the year. And next year, as warrant keep converting, we will get back to the same level of capital adequacy. With respect to the ROA bridge, you are right. We have said that we would exit near about 25 at a 4% of ROA. Now that is a function of the maturity of the market and how the overall scenario is. We presume one of our assumptions was to grow much, much faster rate, sweat asset, at earlier pace. But what we are saying is that we will get to that level of ROA. This is why, if you look at our structure, we have given a CCD at 18 months with some coupon. Because we are saying that this is the bare minimum we have to achieve. It is lot of hard work. We have been, if you look at last 4-5 quarter or 6 quarter, the cost of borrowing has remained elevated. The liquidity for the market have remained slow, but we have not shown you neither our cost of borrowing has grown, nor our liability has got constrained vis-a-vis lot many larger players. That has been the challenge. So in this macroeconomic scenario wherein what is being told to NBFC had to grow at a certain pace, what is being told to have some healthy profitability, we think this is what people should expect from us. We may surprise you, we don't know, but as of today where we stand, what we see the regulatory landscape, what we see the liability landscape, what we see the capital providers, all of that putting together, this is the number for the year year-end to year we are putting out. But one thing we have done, capital upfront, so that if there are headwinds, then we can, take that headwind head on in coming quarters. But I think so for a company with 3.5 years of vintage, 5-year total of which 1.5 years has gone into COVID, 1 year has gone into credit crisis. For a 3.5 year of real operating, size company, this level of scale, product diversity, sheer focus on data and analytics and distribution capacity. In my 30 years of professional experience, I have not seen. But obviously, I understand investors, would expect all companies to perform at the same level. We would also get there very soon.
No, sure, sir. Yeah, Ugro has done an outstanding job of reaching where it has. Now, if you could just give us a perspective of what are the growth rates we are looking for 25-26, and if you could just put that in context with what happened in Q4, where the disbursements were, slightly in a slowdown mode. So that plus the growth that you expect for the next year.
So first and foremost, we were at 3,000 in 22, we were at 6,000 in 23, and we are at 9,000 in 24. Which means this company minimum of 3,000 crore of AUM, it grows. And the AUM growth in the last quarter, what we have been saying, Ugro has established a very good name within the lending universe, and especially in the intermediated market. Some of the lenders which have larger balance sheet capacity actually are taking, asset from us at much faster pace. So the foreclosure for us was a negative surprise, and our foreclosure were higher than what we have expected. Obviously, we will correct that and we will match that at a higher growth rate. So I think so quarterly growth coming at 8% rather than 12-15% was a function of that. What we would do next year is what we are telling you. 3,000 is the minimum base we will definitely do. There is no doubt about it. We think that we would be additional 10-15% of that. But when it comes to management focus, that additional growth we want to only do in the segment of the market which gives us the higher yield, which pushes our ROA. And that's where we are. So now that, whether that is 10% higher or 5% higher or 15% higher, for us now, what matters that incremental growth is all in the higher yielding segment with the lower credit cost. So that's where we are, that's the way we are operating as management team. And I think that's the right thing for us to do.
Okay.
Amit, anything you want to add?
No, absolutely. At the end of the day, growth with profitability will be the focus for this year. And therefore, we are not putting up into whether it is 12, 12.5, 13, 14, but the fact is that we have to inch our ROA towards the 4% as Sachin has spoken earlier, and that will be the focus of the entire team.
Okay. Sir, if you could allow just one final question, I'll come back to the piece. In the bridge from 2.3% to 4% that you just very nicely elaborated. I just have one question on the credit cost. In Q4 itself, you are at about 41 crores of credit cost in the quarter, which if I generally analyze, will be about 2% on the overall AUM. So do you really have that lever of 50 there?
Anuj?
So you're right. In the last quarter, there's a small blip, but that was all planned in previous quarters itself. For the year, we are at around 1.5%, and we have been telling that as we season, we will stabilize at around 2%. So if you only look at that last quarter, we took a call on very, very old unsecured pool and took a write-off of about 10 crores, which was over and above what should have been the normal credit cost. But that it was a one-off event. As per our plan and as per the way we have calibrated, we would be for the next year, we should be between 1.8 to 2% overall.
Great, sir. Thank you for answering those questions. I'll come back. Thank you.
Yeah. Next question we have from Anida Agrawal.
Yeah, hi. Can you listen to me?
Yes, we can hear you.
Hi. First of all, congratulations on great set of numbers. As investor, we are really happy with the kind of AUM growth the company is doing. So, my first question is on the credit cost side. Like, we are saying that at 2% should settle down in terms of credit costs, right? So, how are we seeing at let's say bad credit cycle, business cycle, or let's say any recessionary event, if it happens, and what are the concerns related to that? Because we are dealing with the lowermost end of the company, right? So how are we seeing in such a scenario? What could be the impact to our business?
So, there are two ways to look at this. The way we have designed our portfolio construct, the portfolio construct will remain same as a principle, and that is that 70% of the portfolio will remain secured, 30% of the portfolio would be unsecured. And within this construct, what we have done from last 3 quarters is that we have started covering our guarantee schemes. So if you find our percentage of unsecured, which was 30% 2 quarters back, the unsecured portion, which is not covered by CGT MSE or doesn't have any kind of collateral, has actually come down to 27. So from design perspective, this is how we want to grow, to continue to be at 70-30. Now within that, for each of the product, we have a lifetime estimates of GNPA and credit costs. And those lifetime GNPAs are actually the stressed scenarios GNPs. In normal course of things, actually it would be lesser. But the way we have designed, we want to cover even the stress scenarios. So, of course, a very large unforeseen event happening like COVID, no one can be really prepared. But within the MSME ecosystem, if in a particular state, or if in a particular sector, or if in a particular profile, there is a higher stress, our plan takes that into account.
Okay, that answers my question. Second, I would want to ask you, so are we trying to tie up with any payment platforms like, for say Paytm payments, or not Paytm right now, but other payments like PhonePe or anywhere, where the business's transactions are taking place on day-to-day basis, and according to how many transactions the business is doing, even the small businesses which are not GST registered. So GST registered businesses we are already dealing with, right? So are we also trying to deal with non-GST registered businesses?
So, I want to answer this in two parts. One, of course, we already have a partnership and alliances business where we already have partnerships with whether it is e-com players or certain payment systems or supply chain systems where we leverage this alternate data to provide credit. The second piece is that this is where there will be eventual migration of lot of businesses because it makes credit easier with alternate data available. And so the acquisition of MyShubh is in the same direction, which gives us the power of technology and the platform there to be able to embed ourselves in multiple such ecosystems, test these products and really scale up on this front as well. Also, one has to be cognizant of the fact that whenever we embed ourselves in these systems, these are products which are new age. We need to test them for a while before we scale up. Need to have a clear eye on what kind of credit cost do they deliver, because these, of course, are high-yielding products. But yes, the approach is to moving and adding these kind of businesses onto our fold, and that is why the acquisition of MyShubh.
Okay. Thank you. Just your last question. So we are issuing around 1,300 crores of debentures and share warrants, right? So
Yes.
these are all preferentially issued to certain people. So is there anything which you are looking for retail shareholders as well?
No, so look, there are multiple ways in which a company can raise capital. One, obviously, we are a listed company. Retail shareholders can always buy from the market. We don't restrict them. But in order to augment the capital, there are sources available to us. Obviously, sources, one stated objective of Ugro is to make it completely institutionalized ownership platform. We started with 4 private equity, putting in the entire capital, owning almost, 80-90% of our capital structure. One of the pre-investor, which is PAG Asia, exited from the market, in 2022. That gave opportunity to some large family offices and public market retail investors to buy. That actually happened at the price range of 150 or so, when we are trading only 1.1 time price to value. At the same time, last year, because the company was not well known in public market, we felt our good source of capital is private, and we went to a very long only investor, a sovereign fund, and brought Denmark government arm IFU into our capital structure. And for this capital raise, we felt that if we bring one of our existing investor and few of the large family offices of India, it would strengthen our capital structure. For a company which is already listed, to bring broad-based retail public, the only option is a right issue. And right issue is a time-taking, cumbersome process, and that right issue would require our existing share. The way the right issue work in the market, who people expect the right issue to be done at a severe discount to the traded price, which is not in the interest of the existing shareholder. And that's why we have chosen this route to bring long-term capital in our capital structure.
Okay, sir, I just wanted to say on a lighter note that as an investor, I would me personally, we would have been happy to join in for 10,000 odd debentures or warrants if company would have allowed us. So we just wanted that kind of clarity from the company in future, that even small investors like us should be able to participate in such.
I truly appreciate that. As you would understand our constraint, our business is business of lending. We come and talk to people like you only once in a quarter. When we raise capital, we raise through advisors, and advisors take us to where the, we are hungry for food. Where the food belongs, it's depending upon the servers, which are our advisors. So people who advised on this capital raise, we don't know who all they have reached out. But where they took us, we saw a very great, big success rate on that. But they're quite fully taken.
Yeah, definitely. In future, we would be looking forward to such right issues or maybe preferential to parties interested.
Yeah.
Thank you so much.
I would just say that keep watch. That is why there is a 2-day prior. So Ugro gave advance intimation that its board meeting to be held on 2nd of May would consider a preferential allotment of capital issue. Obviously you would have missed that. Otherwise, you could have sent an intimation showing your interest, and we would have definitely included you. But no problem. We'll find a way to make sure that interested people, if they want to come, they should be allowed to come, so that capital is not prerogative of only few. Anyone who want to participate in Ugro's capital structure, we really value that, irrespective of the size and who the person is.
Thank you so much, sir. Very grateful for that. Thank you.
I request every participant to restrict yourself to 2 questions. The next question is from Rutul Sir. Please go ahead.
Hello, am I audible, sir?
Yes, you are very well audible, sir.
Yeah, sir, congrats for the great with respect. Hello.
Yes, please go ahead.
Yeah, my question is with respect to the AUM guidance that we gave earlier for FY25, which was around 20,000 crore. And now we are not even talking about it. We are talking about 12-13,000 crore AUM. That is one thing. And secondly, we have raised capital way more than what we were planning. So from both the sides, if you see that we are raising higher capital and also guiding for a lower AUM. So as an investor, we are not able to understand that what actually is what is the reason that this things are getting changed. If you clarify on that aspect.
Yeah, and the third thing which we have not guided you is what we are guiding to you. See, for any investor like you, there are 3 things which are critical. 4 things which are critical, especially for lending business. Successful lending businesses in India, first and foremost, the cardinal principle is that they should show some level of stability, predictability, and that's why these businesses should have 5 core parameters. They should grow between 30 to 35%. Beyond that, you take too much of risk. Below that, you are not attractive. Second is that they should deliver a good ROA performance, return on asset performance. If you're not a bank, banks can survive on 1.5 to 2% of ROA with a leverage of 7, 8. They get to 18% ROA. NBFC should deliver at least 3 to 4% of ROA. Fourth, the credit cost should be has to be a very sustained line of 2 to 2.5%, not beyond that. Income to OPEX ratio should be between 40 to 45%. And depending upon who the parent is, leverage can be between 4 to 7. We said leverage to be up to 4 and co-lending actually supplement for the leverage. That is what we think. If we achieve for next 5 years, that is what would reward the investor. So in lending universe, you have companies which trade 6 times price to book multiple to less than 1 time price to book multiple. Just look at the NBFC curve. But what correlation you will always found is ROA and growth rate performance. The question is that you said that by FY25, we said by exit of FY25, if we were to achieve a certain level of AUM, but that AUM was not helping the cause for other 4 parameters, then we have to recalibrate and adjust. We have proven our capability to growth. If you think the growth, or if what we have learned, if growth is the only parameter for value creation, we can grow at 100% for next 7-10 years. That's not a problem, because it's a 90 lakh crore of credit gap, of which 80% is in the target customer segment of Ugro 15 lakh to 15 crore. You can grow as much as you want, but that level of growth requires a different level of capital, different level of liability pricing, so on and so forth. Market situation changing, liability cost getting this, we would grow. But what we are saying is, what is that we want to achieve? What we want to achieve is a sustainable level of value creation for our existing large shareholder, for every public market shareholder, for the new investors which are coming now, and that we believe is a function of growth, combination of ROA and ROA performance. We will do that. That is the most priority than everything else. So I hope that answers the question. Second, why we are taking that much of capital? We have said that we take for 500 crore of capital, but on the headline number basis, we have taken 1330 crore of capital. We have done that. So, so who is, existing large investors are taking massive dilution at a price to book multiple of 1.6, 1.7 times. They should be very, very unhappy. What we told them, we said that we can do tranche capital raise. We raised 300, 400, 500 crore capital now. We raised 1 more round of capital at that point of time. Given that we got so much of reception, acceptability from some of the most prestigious names in the country, we said because this is structured, it is a gradual dilution. It is not an immediate dilution. I'm giving a CCD which will get diluted when it's get converted. Company dilution would happen when warrants would convert. And that's why if we can lock all the 2 years of capital need for our growth rate, exactly same growth rate what we have planned, we should take it. Because it may so happen that at this level of capitalization, not just today. So today, our capital adequacy would go up by 550 odd crore, and when the warrant would convert, the next level of capital would come in. But it might lead to give more confidence to rating agency, which might lead to a rating upgrade. It will give more confidence to all of our 30-40 large lenders that this company has no problem of capital. So it will also increase our leverage and reduce the cost of borrowing. It gives, if there is a hostile environment, if there is a little bit of any change in the ecosystem happens, we have the capital. So I think so that's our rationale. We generally believe that what we say and what we deliver, investors are very smart. They understand the real intent of what we are saying. We wanted to tell all of you that we have the capacity to grow while we are a young company. There is no company in India in the lending space, especially the NBFC, which has delivered 9,000 crore of asset in 36 months flat with the credit cost. And I am saying it with a lot of sense of responsibility. And now we are saying that in next 24 to 36 months, our next foot stop is to deliver relative profitability which matches to the best of the peers. Because we are in it to build it for life and create an institution. And some of you who are participant of that journey would judge us on an every quarter basis, and we are happy to answer to all of your questions for that.
Thank you so much. It's a great answer to that. Just one question. What is the peak leverage that we are thinking on the business model that we are? So you mentioned about 4x limit. So is it so?
Yeah, for next 2 to 3 years, so we have not built more than 4.5 times multiple on the risk.
Okay, got it. And just last question from my side. So this year we have like 3x our profit from 40 crores to around 120 crores. So can you guide us on the profitability that how much, in what range the growth would be for FY25?
Sir, I would say there are too many moving parts when it comes to the real bottom line performance. Because there is a cost of borrowing element, there is an off-book percentage of element, there is a yield element, there is a credit cost element. I would be unfair sitting right now to exactly give you the number. We can only talk directionally. Directionally, in 8 to 10 quarters, we want to achieve 2 to 4%. And every quarter, we want to demonstrate our journey towards that. I think so you can do the math on your own.
Can you just say whether the PAT growth will more than the AUM growth or it won't be the case?
I'm just trying to calculate.
Yes, of course, it is likely that our PAT growth will be higher than the AUM growth. Otherwise, this target of reaching 4% 4% ROA cannot happen.
Yeah.
Okay, great, sir. Thank you so much for your answers. All the best.
Thank you.
Yeah. One question from the chat. The question by Amit is, what went wrong in supply chain lending? 14% yield channel is seeing 4% plus GNPA. Any learning from this? What corrective actions we are taking?
I'll take it. Overall, the way for an NBFC like us, the supply chain finance ecosystem has evolved, and the way we see the opportunity, we think that for our kind of institution, which is focused on a digital data science based solution, the last leg of supply chain, which is from distributor to retailer, fits in the best. The exposures are granular. More and more retailers are getting digitally enabled. Technology solutions are available to onboard and underwrite them seamlessly. And the rate of interest or the yields which are desired can be had from this segment because there is relatively less penetration. In our experience, when and the main anchor to supplier side and anchor to dealer side is more large NBFCs and banks domain, and we don't want to compete there. It is pretty much touch and feel underwriting. We tried and tested for our systems, but we found that our moat would lie here in the last leg. Now, coming to a relatively larger NPA within our product portfolio, it is a function of the AUM growth which we had. So there were a few bad apples, and some of them, one or two anchors have been with us in a stressed kind of a scenario for now 3-4 years, just after COVID and just after COVID. And because we didn't want to grow the AUM in that space too much, as a percentage, the GNPs are looking higher. What we have decided now is that we will have an accelerated rundown of that portfolio, and we will progressively build the granular last mile retailer finance portfolio.
I would just add to talk about Anush said. For the benefit of everyone who is listening, supply chain as the ecosystem component have multiple legs. The first leg is a vendor supplying to an anchor, and banks lending to the vendor, believing that the money would come from the anchor. It is nothing but an off-balance sheet exposure to a large AAA anchor. Now that the financing happens in a rate of, it can go on threats at 7, and without threats it's at 8%. Now we can't compete that. Our cost of borrowing is 10.75. Second portion is the anchor selling to a very large distributor, which also have a CCOD facility from a bank. So on the both side of that spectrum, we were getting customers which were lower rated and were willing to pay our price. So theoretically, we were getting negative selection, a BBB minus company, BBB plus company. And we realized that that is not where we should be. And some of that reflection is in the NPA. While what I said that because the portfolio is running down, the NPA is looking higher. Had we grown the portfolio, it would look the same. But that's where we felt that for a AAA anchor is that AAA anchor's last mile retailer, nobody provides the financing. Because that requires physical infrastructure, digital infrastructure, data science driven underwriting, very small ticket, and that's where we should focus. Learning is we should play in the segment where our strength is. Ugro's strength is to understand data, underwrite that basis. Ugro's strength is then take the case to an underwriter who does a templated basis underwriting. Third is Ugro's strength is physical distribution and collection infrastructure, which is today at 105 locations, going to almost 400 locations in the next 2 years. And we will play all our product segments to our strength rather than competing to the people who have balance sheet level strength, not other strength.
Okay. We'll move to next question. Our next question is from Omkar. Please go ahead.
Hello.
Yes, go ahead.
Hi, sir. Congrats on the fundraise as well as the results. So my first question is on the co-lending income. It has been very strong during the quarter. So is this a one-off because it's a Q4 or is this going to be?
So co-lending income, as we have said, that co-lending is gradually increasing. The proportion of co-lending in the overall AUM is increasing. Hence, the income is increasing. This quarter, a little bit of blip is there on the higher side because we have done rate reset for our customers, which has resulted into the higher upfronting. So a portion of it you can treat as one-off.
Okay. Understood. And in terms of cost of borrowing, which we have said that it is going to come down. So are we looking at any credit rating upgrades in, let's say, next 1 year?
So there are multiple parts to it. First part is that on the broader interest rate side, we think that considering the global scenario and considering the domestic scenario, interest rates are unlikely to go down in the first half of the year at least. It may take even third quarter or fourth quarter of the year before interest rate starts going down. But considering our vintage, our performance, and our strong relationship with multiple sets of and multiple kinds of lender sets, and also coupled with this equity rate, which is fairly large, which is almost equivalent to the current equity which we have, we should get rating upgrade. And also it will give additional comfort to our existing lenders, because equity always gives significant comfort to the lenders, so which should help us in terms of bringing down the cost of borrowing. We had a rating upgrade in March. On 15th of March, CRISIL upgraded us from A- to A stable. So quick rating upgrade does not come by, but we are quite positive that once they get to know about this fundraise, we should get another round of rating upgrade shortly.
Okay. Thanks, and all the best.
Next, we have a question from Anil Tulsira. Please go ahead.
Yeah, thank you for the opportunity. Couple of questions on ROA bridge. Microloan is giving you a lot of increase in the expected ROA. So can you explain what giving you confidence to increase the branches from 75 to 250, and what has been the experience in recovery from the past defaults? That's the first question.
Okay. So if you've been following us, we've launched these 75 branches in the year 22-23. At that point of time, we opened these 75 branches, and we waited to see how do these branches perform, what is the learning, and we've seen that all these branches do break even anywhere between 12 to 15 months. Given the accelerated learning after that on our micro enterprises model, we are opening the next level of 75 branches, and also we've already opened. These should go live during this quarter, and the next 100 branches will come in during the year. And so the confidence is coming from the fact that there is a proof of concept, there is accelerated learning curve, there is a product suite that can be distributed out from these branches, which our peer sets may not have, and therefore the productivity is higher. And from here is where with a strong base, there is an ability to scale up and grow.
Okay. And sir, my understanding is right, the entire loan of microloans is secured by the central agency?
No, the micro enterprises loans are secured by property, either residential or commercial. These are loans up to 25 lakh rupees in tier 2, tier 3 towns. And they're secured by property.
Okay. And so the next question is on the cost. So the entire decrease in the cost will be only because of increase in the scale, or we are taking any steps to reduce the customer acquisition cost?
So both the reasons combined. There cannot be one. Both the reasons combined. One, of course, that there is an overall scale impact which is leading to the whole reduction in cost to income ratios. You would have on year over last 2 years, and we'll keep going from the current band towards the range between the 40 to 45% over the next 8 quarters. That's number one. Number two, cost of acquisition. There are multiple channels where we acquire. The intermediate channel is a very, very commercialized channel. We all know a lot of other players also play in the channel, so cost in these channels are more or less standard. However, as our productivity increases in our micro enterprises, the equipment finance loans, and our direct channels, our cost of acquisition will keep coming down, which will also add to the drop in our cost to income ratios.
Sir, and the last question is on the DSA. DSAs are known to, they might take the file to anyone who's giving the higher commission. So do we have any plans to increase our own channels, our own men on the street to source the loans, or we will rely more on the DSAs going forward?
Our intermediated volumes, if you've been following again us, have been at about plus upwards of 58-59% last quarter. If you look at this quarter, they are around 55%. At the end of this year, they will be in the range of 45%, which means that given our expansion in micro enterprises branches, given our expansion in the ecosystem business, there is a conscious effort to move away from the dependence on DS. That's number one. Number two, this also is imperative because Sachin also touched upon the foreclosure rates, and these foreclosure also are a function of how it was originated, and we felt the pinch of it last year. So there will be a continuous conscious effort to move away from the intermediary channels. We see this going towards 40% or sub 40% in next 8 quarters.
So the last question is on... Sorry.
I just want to add. I just would be a little unfair to say that DSA take file where there is the highest rate. See, intermediaries in India play a very important role to get timely credit to medium-sized MSME, right? So, and the actually rate of intermediation within DSA industry is more or less uniform. While there are competitive pressure, if suppose a new player enters, it might give 10 basis point higher. But actually what DSA needs, so for secured loan, between 1.25 to 1.5% is this standardized commission rate, for a business loan, 2.5% to 3.5% is a standardized rate. For machinery and rooftop solar and other product, DSA don't do it. We are actually making them learn how to do it. What DSA actually want is a good price for the customer and a very superior turnaround time. Our turnaround time, so vis-a-vis players, big players, right? All of the big names in the industry, we win business on the basis of our power of turnaround time. Machine says yes and no, a platform in 60 minutes says give in principle approval, and that is why at a little higher blended portfolio yield of 12.75, 13%, vis-a-vis competition does it at 10.5%, we still win our business. The only trouble or only challenge is this is a customer, because of its primeness, is always hunting for a lower rate. So once if customer comes to us because of our turnaround time, the competition offers at a lower price, then it moves away from us. And the way we think is that we have to engage our DSA partners with multi-product. We will gradually become more competitive on the pricing side. And that's why this would remain an important component of our business. But we are doing disproportionate focus on building our direct universe. Today, of our gross AUM, it is a 50-50 split. 50% comes from our intermediated channel. All of our micro enterprises is direct. All of our machinery is direct. All of our retailer financing is direct. All of our partnership and alliances there is another NBFC or fintech. All of our digital is direct. So this proportion would tilt gradually. So from a 50%, the intermediated would go down 40%, go down maybe 30-35%. And the reason why it would go down, because there are more product being added to intermediary channel. We are telling the intermediaries, you can also do rooftop solar. Now, because it is in our interest that our intermediary partner also learn to do more things than just selling a lab or a business loan. So absolute volume may not go down, but our focus is to increase our funnel to direct customer. It is not that we are averse to DSA. No, some of our DSA partner might be listening to this call. This is live on YouTube, Facebook, all of that. Also, I want to tell them you are an important partner to us, but we would like to own the customer and service the customer need, and that is why we are going more direct.
Got it, sir. And my last question is on MyShub Life. So just like micro loans, these are the unsecured loans. So will this be under insurance of the central government?
So we can, if you want, we can take it. Depending upon so these loans are priced largely at 30%. They have a short tenor of 30 to 90 days. EMI comebacks on daily basis. The price, so we have presumed a very high credit cost and the pricing being low. We will see whether we need credit guarantee on top of that or not. So you can see the credit guarantee is nothing but an insurance. You can actually take the same insurance on your own by over provisioning for that. So we'll see over a period of time, but the customer segment would be eligible for credit guarantee scheme. In fact, this would be, most of these customers would be eligible for Mudra eligible for CGFMU, and also some of them would be eligible for CGT MSME as well. And as you know, under the, most probably, if you read the BJP manifesto, and if they happen to be the next government, they have promised that the mudra limit will be increased from 10 lakh to 20 lakh rupees.
Thank you, sir. That's it from me. I'll join back the queue.
Thank you, sir.
The next question is from Sonal Gandhi. Please go ahead.
Hi, congratulations on the fundraiser. I had 2-3 questions. So one on the co-lending income. So you've touched upon it. So the question was basically we have done some reset, right? Our yields are up almost 30 basis points on a blended basis, QOQ. So that is the yields are higher in this quarter because of that rate hike, right? If I look at co-lending plus direct assignment AUM, and if I look at the income which is upfronted, that is almost 19% versus about 14.5% in previous 2 quarters. So maybe if you could help me or guide us, how should we kind of build that number in next 2 years?
So it depends upon the product mix as well. Every product comes with a different yield band, and the upfronting will depend upon the quantum of DA or CLM2 which we do in that product segment. So if the business loan segment or the micro business loan segment where if we do higher, even if we do lower numbers, then the upfronting would be significantly high, because those products are at 19 to 20% yield band, and bankers would normally take around 9.5 to 10%. Compared to a Sanjeevani secured product where the yields are 14%, the bank would still take about 9.5%, so the margins would be significantly low. So we have to do significantly higher volume to earn the same quantum of the upfront income. So it will depend upon the mix of all the products that how much income would come in. And of course, this quarter, as I explained earlier, that we have done rate reset for all our secured products which were on floating rates, which has given an additional blip on this upfronted income.
So Nalin, your question of how do you build the model, I can only help you with a few facts. Look at our by product, how much of that has gone into the co-lending, and then there is a bifurcation of co-origination and as well as co-lending. Co-origination is largely spread income. Co-lending is largely, recognition income, which comes all of the upfront at an NPV value. If you apply that metrics, and we are also telling you that if we are at run rate exit at 550 crore, incremental AUM growth will come in higher yielding micro enterprises secured loan. And there is a percentage component of that which is already in the co-lending. So you cross-reference these two, you'll be able to get to their model.
Right, sir. So I've done that. So that's what, 19% is the rate this quarter, and previous 2 quarters it has been 14.5%. But maybe I can take this off.
We can have it. So Sonali, we can have a separate conversation. Obviously you are a coverage analyst, so you will have much deeper level of questions. We can help you with some of that if you don't mind. But please go ahead with the rest of your questions.
The second question was, so we are talking about increase in yields by about 150 basis points. Now, I understand micro enterprise loans is going up, and that's a high yield product, and probably the secured product might go down. And what I understand is...
No, of course not. No, ma'am, we have not said. We said...
As percentage of AUM.
No.
No, actually it won't. What would happen, so it's not that so all of our 25 branches which do, high ticket 13.5% secured loan, we continue to do that. Incremental volume. So if suppose, theoretically, if we are doing 550 crore a month, and if we were to do a 600 crore a month, incremental 50 crore would come at 20% yield, which is also secure. But it won't change too much of percentage. What it would change is yield band, but not too much of percentage.
So maybe I framed my question in the wrong way. Let me just reframe or rephrase it. So secured prime, probably as the focus moves more on micro enterprise, will continue to secure also, secured prime. But the percentage of micro enterprise loans will increase as percentage of our AUM.
From 12%,
it stands about 8 to 9%.
From 12%, it will go to 20%. Close to 20%, yes.
So, and the differential would be about 700 to 800 basis. So that would kind of, yeah, that would give us about 0.8, 0.9% kind of increase in our yields. The rest 60 bips, where are we expecting that to come from?
From retailer finance.
From retailer finance, from our digital channel, little bit of, yield threshold band we have now set. So for all of our partnership alliances, we have moved it up by 100 basis point. Secured, we have moved up by 50 basis point in prime. So there is lot of small activities which has been done. But you are broadly right. Now 0.9% to 1% comes from micro, around 0.25 to 3% would come from our retailer financing. But that book would take time to grow, and balance is series of action across our product line.
Reset done because probably the number what is reflecting so far is about 30 bips in the yield. So can we expect like another 20, 30 bips in the next quarter?
So the reset was done on 25th of January. So since then, the entire book has been, almost the secured book has been reset. So the numbers would continue to reflect the way they are in March.
Understood. And the next question, sir, on the acquisition which we've done. So if you could just spend some more time talking about it. So what I understand is they are a platform, right? With other payment apps and all. So we'll get data from that platform. I mean, if you could just talk a bit about the acquisition, that what are they exactly doing? What is their current book and
Yeah. So what they exactly do, I'll give you a case study. So what they exactly do, so if there is or there is Airtel Payment Bank, and if there is a merchant who the QR codes of these banks are there. Now a merchant needs, suppose 50,000 rupees to buy some material, and he needs credit for that. And he wants that credit he should be able to repay on a daily basis from the payment which he is receiving from his customer. What is available is that all of this payment is get reflected in a Airtel or a Fino Payment bank account, and the transaction flow is visible. What MyShubLife does is that it integrates to some of these payment ecosystem. What it gets through the consent of the customer, the access of the transaction flow, money coming in, money going out, and basis that its data algorithm underwrite credit and tells for a short tenor of 30 days how much of money can be given to the underlying customer. So that is what MyShubLife does, and it has proven that model works for almost 6-7 years. Once this platform comes, what they didn't have is the balance sheet. When the platform becomes our subsidiary, platform is already integrated to some of these systems, and we provide the balance sheet and our supervisor and probably reduce their cost of borrowing. And that would lead to more customer acquisition and the acquisition of P&L for us. Transaction structure I've already explained. It's an acquisition for 45 crores, which is valued not like the way VC's valued fintech platform. It is valued at 1.9 times price to book value of the target company. So target company already have 28 crores of capital, and we have acquired for 45 crore. 36% of that is being paid in cash to give exit to one of their investors, which only need cash, and balance they will take shares of Ugro at the same price on which we are doing the preferential allotment. So these are some of the best VCs and early stage funds in the world. And they will be a very small shareholder, but they will come on our capital.
So what is the total employee count at the end of Q?
What is the total employee count at the end of Q?
Yes.
Of Ugro?
2,500
around.
Just about 20, a little more than 25.
Thank you so much.
Yeah. Before taking up the next question, request all participants to restrict up to just one question. So next question we have from Mohit Ansari. Please go ahead.
Avinash, we can go to next question. We are not able to hear anything.
Next question is from Parul Upadhyay.
Hello.
Hello.
Yes.
Yeah, my question is about EPS. You have indicated that for the next 2 years, the AUM will grow at 30%. So I am assuming that the profit will be more. So even if the profit goes up by 45%, then at the end of 2 years, after equity dilution, we will still end up with an EPS of 19 rupees only from the present EPS of 13 rupees. At the end of FY26, our EPS will go up from 13 rupees now to around about 19-20 rupees. It won't go up more than that. Then how are we going, retail investors going to, means market is not going to reward you with a increased price. The way you have diluted huge equity dilution.
Yeah,
EPS
we will
growth
answer.
now will be
So,
stunted.
sir, we'll give you the clear answer to that. I think so. First and foremost, while earning price to earning ratio, PE and EPS are very critical parameter. Lending institution generally get valued, and you should speak to most of the analyst fraternity, get valued on the basis of growth, ROA, ROE performance, and that define price to book value. And obviously EPS is embedded into that. But I think so our capital is coming in a staggered fashion. Second, once we get to a 18% ROE, that is on diluted capital structure. An 18% ROE would lead to what EPS should.
So we have to see at that point of time. So as we guided that our profit growth would be definitely significantly higher compared to our AUM growth, and that would continue to be the trend for next 3 years, and where it will be significantly superior. So if you see last year our AUM was 6,000 crore, but profit was 40 crores. This year our AUM is 9,000 crore, but profit is 120 crore. Of course, next year it will not be 3 times, but the trend will continue.
Yeah, so the way to think about is that at 264 rupees, total 1,330 crore of capital, when it get converted, what level of number of shares it would add? It should be adding around
5 crore more shares.
5 crore more shares. So from 9 crore, it would 14 odd crore total number of shares. Our capital base from 1440 crore, 50 crore, we will add 1330 crore and 2 years of profitability. Should be, whatever it is the range, we can't give you exact number. In our estimate, on that when we apply 18% EPS, 18% ROE, our EPS would be far superior than what it is today. Hi. Is it clear to you, sir? Avinash, can you hear us?
Yeah, I get you. So that's what I am estimating. The profit will grow, EPS will grow at 45%. CAGR. Even then we'll end up with after this equity dilution, 20 rupees EPS, which will not be a good performance compared to our competitors. That's what my primary concern is.
No, sir. I think so you're doing the math not correctly because, this first and foremost, lending business, you always would be adding more capital. Now, it depends when you add the capital, whether the resultant is making capital more efficient or not. So theoretically, at a 1450 crore capital, we add 1300 crore capital is 2700 crore theoretically. And this is not the number you should catch hold of us. Suppose we add around 600 crore of more profitability, which would be around 2700 to 600, 200 odd crore. And you do 18% of ROE on that. So, which is the profit into capital, and then you calculate EPS on the diluted shareholding and you'll get to the number.
Okay. Thank you.
Yeah. We take next question from Pablo Paja.
Greetings to everyone. Greetings to Mr. Nath, Mr. Pandey, Mr. Monday, Mr. Lodha, and Mr. Agarwal. My question is, first of all, congratulations on the fundraising part, and given the potential for increased loan origination volume and portfolio growth in QF 2024, how is Ugro Capital ensuring its IT infrastructure can efficiently scale to meet these demands while maintaining optimal performance and data security?
Sure. Yeah. Okay.
if you look at in last 2-3 years, we had a growth phase, right? And there is a lot of new systems we built in, lot of processes, a lot of IT infrastructure, physical infrastructure, all that we built. Okay, and now we have consolidated, all our IT stack and including, our ops infrastructure, right? And we have put, information security officer also in our department. This is that, we have put all security layers, whatever is required, firewall, everything, okay, which can meet this demand. At the same time, on an operations side, we did a study also, and we are confident to manage 2x growth with the same kind of manpower, with a lot of productivity increase at branch level, some of the process enhancement initiatives which we have taken, which we can easily meet this growth demand.
I would add to what Sharad has said. Philosophically, Ugro is designed to early capitalize, or early invest, and then augment growth. It started with 1,000 crore of capital. It invested in its management team and technology and physical infrastructure, and it grew to a level. Intermediary, it took a small capital increase, and now it is re-upping what it did in 2018. Same level of capital it has taken, but this time, all of the stage 1 investment in technology and people infrastructure is not to be repeated now, and we can take too much accelerated growth and more operational efficiency.
Thank you, sir. Thank you, everyone.
Next question we take from Amit Parikh. Please go ahead. Amit, can you please ask your question?
Hello.
Yeah, Mr. Parikh.
Am I audible, sir?
Yes, very much.
Okay. Sir, I would just like to ask, we went for a preferential issue. We could also be gone for cash issue, sir. Why not the same?
Sorry, come again?
We went for preferential issue by issuing warrants to some additional investors, right?
Right.
Why we didn't go for cash issue, sir? Because what actually happens is, we are unnecessarily favoring new investors. Do we not value existing retail shareholders, sir?
So it is the other way around, sir. If we had issued the shares in cash fully, then the existing shareholders would have been diluted immediately. Rather than taking the immediate dilution, we are staggering it for 18 months.
Sir, but existing investors are not there for a single or 2 quarter, right?
Yeah, absolutely.
There is a time concept of time value of money, and if we give sir discounts in the name of warrants for 18 months, the 10 to 20%, 20 से 25% का discount मिलता है sir existing new investors को.
Yeah, but it comes with a rider also that they have to be logged in for once they exercise the warrant, then they have to be logged in for 6 months. So some riders come in, and considering the current scenario and considering the external environment, we thought that this would be the best structure. That is why we have gone for it. And if you look at which we could gather by way of this structure, which normally otherwise could not have come in a direct cash equity raise, and probably it would have been too dilutive immediately for the immediate shareholders who are there. So if all the conversion happens after 18 months, then for 18 months the existing shareholders does not have any dilution.
And also, sir, just on the lighter side, we believe Ugro have massive potential to get re-rated. So where we trade vis-a-vis some of our peers, we think so we are highly undervalued. And we wanted to make sure the incoming shareholders stay with us for a while. And it should not start happening that we allot equity and next third day if the price goes up big time and all of these investors exit. So that's why also we wanted to make sure that we lock in them for some period of time.
If you are a very high growth company, sir, having good potential, why would the incoming investor sell off the shares and go away, sir? Are we not concerned about our capabilities? Because actually
Sir, I wish
we have raised,
investment would look at this way.
Existing market
Look
cap
at it in a
additionally,
different
right?
perspective, and people make money in a short period of time. There is always an incentive to book the profits, right? So anyway, that's a more philosophical level, and that's why I said that we think so. This was a good structure to lock capital, attract high quality investor, and get capital in a staggered manner through this method.
You said you have attracted high quality of investors, sir, but you have added new hundreds of investors for such a small amount, sir. How can are they not convinced by putting in heavier amounts in your company, sir? Because no large good institution.
Okay, we'll answer this last time and explain you the context and rationale, and probably we'll move on to the next question. First and foremost, this company has attracted some of the world's best equity investor in form of private equity, some of the world's best DFIs. It has so its entire capital base is institutional. So nobody should ever question about ability. One of our existing investors put 500 crore of commitment in this capital raise, and which is a blue chip private equity investor. Some of the best family offices have put very substantial sum of the money, but we don't want to create concentrated shareholding. Concentrated shareholding means that at some point of time, the concentrated shareholder would like to exit, and that creates pressure on this stock. And that's why we want to diversify and democratize our ownership. That's our strategy, and that we think is best for our company.
Yeah, we take next question from Piyush Bothra. Please go ahead.
Yeah, my question is on the quality of the on-book. So we see that the on-book NPA is around 3.5 and the total book NPA is 2%. I believe the underwriting parameters should be same for both on-book and off-book. Is there any specific reason why the on-book NPAs are much, much higher than the off-book?
It is actually the way it is designed. What happens is when you do off-book, a substantial part of that is co-origination. And in co-origination, we tie up with other NBFCs and we give FLDG. And when that co-origination book, FLDG is utilized, only those cases come back in our book. And that is why as a percentage, it looks higher. But a correct perspective to look at would be the AUM. Because going forward also the strategy is to be at around 50% off book. And out of that 50%, a substantial amount would be in co-origination. So this differential will keep happening.
So you mean to say if the loan goes bad on the co-origination one, then it will come back to Ugro first? So
because FLDG is utilized, we had given FLDG.
I believe the FLDG is only for the NBFCs, right? For banks
only for NBFCs. Yes.
So it's in the range of 5 to 7%, if I'm not wrong.
5%.
Yeah, about 5%, and it is utilized at actuals. So the whatever the NPA rate is for that.
So going forward, when you're
and also
please go ahead.
Yeah, go ahead.
Okay. So going forward, when you're increasing that 3,000 crore of AUM this year, so this is there any thing related to the secured and the unsecured book? Like you're doing more unsecured on the on-book side or more?
No, nothing like that. If you see the on-book versus off-book percentages across our products, they've remained steady for last 4-5 quarters. Yes, lot of unsecured portfolio historically has gone into co-origination. And because unsecured has traditionally higher NPA rates, that is why the reflection on book of that is relatively higher. But we plan to move steadily to banks even for co-origination. And once we transition that, and that will take, because it requires a lot of technology integration on banks' part, etc. But once we do that, then this differential will start.
So what's the comfort zone for a on-book GNPA for you? So right now it's 3. What's the comfort level for you? Like it can
so it's because it is a number which is a derived number in our case, That's why the overall our planning is at an AUM basis. But we are quite comfortable, and a lot of our banks covenants are basis that comfort, and we are quite comfortable to go up to 5%.
Okay.
I will try to explain this way that while we maintain everything is the AUM level, our financial institutions also look at on-book GNPA, because flow rate they calculate on basis of on-book. Now, it's a little complicated. We have a co-origination wherein we have given the FLDG, so that portfolio technically is on-book, while it is, de-linked, and we are not applying capital, but we are applying FLDG. We have a co-lending book wherein this is no recourse to us, and we have an on-balance sheet. So, we are trying to alter the model in a way wherein the on-book plus off-book should come to the parity. We always think that the on-book would run in this rate, because certain high-yielding product which banks don't understand would remain on our balance sheet, and rest will continue to go on off balance sheet, and there is a recourse and non-recourse base. But broadly, you should take that what you are saying at a AUM level will be in this range, and at a balance sheet level will be in the same range.
Apologies for my ignorance. Did you say that co-origination is on-book?
It is technically it is not on-book, it is off-book. So which means there is no capital adequacy required for that. But given there is an FLDG, we provide, we provision for that. Because if I have a 15 or 20,000 crore of off-book in form of co-origination, and I have provided 5% FLDG, then I have to provide for potential credit cost on book today. So to that extent, and we earn the interest spread. So to that extent, we take the risk of that portfolio.
So just one quick update, if you can share on the Grow app. You had a pilot app on it 1 year back, and a lot of advertisements we saw on TV as well. What's happening on the Grow app, if you can just share?
So it has to be paper. It is working very fine. We are continuously adding our customer, except one problem. We launched our GrowX app with a core premise that it is a credit on UPI platform. Because it was technically India's first credit on UPI platform. Simultaneously, RBI guideline on credit on UPI came, in which, by design or by default, they said credit on UPI would only be available to banks and not to the NBFC. What it meant that our core proposition that if customer takes loan on app, it gives, receive the disbursement through a QR code and it pays back through a QR code, actually got stopped. Now we pivoted that and became an app when credit is available, and then it is being designed to disburse through NASH and recover through NASH. It is working fine. Now what we are doing is two things. Every customer of Ugro, we are offering GrowX as an attachment so that the app continue to function. Some of its functionality is now would be used with MyShub Live in terms of retailer financing. And one very large lender in India is also trying to white label, which is a bank equivalent, and they are allowed to do that. I think on a long-term basis, we believe that RBI will finally open up credit on UPI for NBFC as well. But it's like an NBFC credit card kind of a thing. And we have to be ready for that. In the interim period, we are monetizing our investment and our brand cost by these three steps.
We take next question from Amit Jain. Please go ahead.
Avinash, just we have 10 more minutes because we have an internal, town hall with the employees, so we can probably be here for 10 to 12 minutes.
Sure. So Amit, please go ahead. Amit, your line is on mute. Okay, let's move to next question. It's from Manoj Kumar Bora. Go ahead. Yeah, Manoj, please go ahead. We take next question from Deepak Yadav. Please go ahead.
Hello, can you hear me, sir?
Yes.
Yeah, so congratulations for a nice set of numbers. I just have one question. Actually, how we calculate ROA, is it on consolidated AUM basis or is it just on or off book AUM? Because I was just trying to cross-check this number, like it's 2.3% for this year, and the AUM on console basis is 9,047 crore. So if we
we are considering it on the balance sheet basis, not on the AUM basis.
So, okay, understood. Okay, thank you.
So we will take that as the last question. And I now ask Mr. Sachin Nath to give his closing remarks and then close the call. Over to you, sir.
No, thank you, MK team, for arranging this call. As I said in my opening statement, Ugro is a young company. It has built with lot of passion, rigor, in this round of capital. Not just me, you would have seen that the entire management team of Ugro also invested their saved capital into the company along with the investors. They are also a great participant to the ESOP scheme, which is tagged to the price of the share of the company. We genuinely believe that India's MSME deserves a chance. They need to be provided credit. They need to be given opportunity to grow because they provide employment to millions and millions of deserving people of this country. Given that India's ecosystem is growing, given that the MSME contribution to GDP is growing, given that our tier 2, tier 3 towns are maturing, all of us, at least some of us who come from those small cities and towns, have this aspiration to make Ugro as India's predominantly small business financing institution. This capital raise, this result is in line with that, and hope with every passing quarter we will continue to give a good result, and hope with all of your help, support and blessing, Ugro in few years would be India's largest, most revered financial institution for SME. Thank you very much.
This marks the closure of this call. Thank you everybody for joining.